pricing signals are the most important signals right now. Credit default swaps, interest rates, yield curves, right? Bitcoin. Yes, I agree with that. But I think you might have your hyperinflation of Bitcoin. And I think what we're coming to, if you seem to be nodding when I say what I'm saying about the banking system and the risks to the economy, it's not going to be inflation. It is not going to be inflation that we're worrying about this year. It will be something else. It may be counterparty risk, but I don't think it's going to be inflation in the prices of goods and services. And many people will say, oh, the dollar is going to collapse. Well, the dollar is measured. If you're measuring it in terms of prices and goods and services, right now it's going up if you're looking at commodities, right? The dollar is appreciating. If you're looking at it in terms of other currencies, after a 25% run in a very short period of time, it's come down. But at the same time it's come down in the last few months, commodity prices have come down. Just to give you a sense of what investors in banks are being told, President got up and said, the depositors, your deposits are secure. And we want you to know that. And the people responsible for this are going to be fired, any decision maker, and any equity or bond investor is going to be, he used these words, wiped out. Velocity will go down, and that the risks to the economy are to the downside here, including inflation. I understand why Bitcoin went from 19,000 on March 13 after the weekend of Signature and Silicon Valley Bank basically going into receivership.
Every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
What kind of message is that? But we probably should wrap this, and I actually have an interesting way of doing that, because during my discussion with Art Laffer, we were talking about Bitcoin, and he said, we really need to add, in terms of trying to figure out what's really going on out there in terms of the money multiplier, add Bitcoin to the monetary base, and we'll get a better picture. So he's already thinking in this way. And I was so happy that he said it. Half of the solution is understanding a problem and understanding how we should try frame things to understand what's really going on out there. So this idea of adding Bitcoin, which is a little over 500 billion, to the 8.5 trillion in the monetary base, it was a start. And, a start of a conversation, because we do have to deal with the world we're living in. The one you're talking about, I think, will evolve over time, but it doesn't happen overnight. You might say the banking crisis is giving us that opportunity, and I think it may happen faster than otherwise might have been the case. But, I am going to continue paying attention to market signals. I see credit default swaps settling down a bit. We haven't seen the regional bank index break down again, but it hasn't V-shaped either. So I think that's a risk there, that there's another episode. So we're watching all of this very carefully and watching the stock market. Now, the stock market is very sensitive to all of this. And it is very interesting for me to watch the stock market levitate through all of this. And I think one of the reasons it is it smells the end of rising rates. It sees over whatever the Fed's going to do right now to much, much lower interest rates because of this deflationary pull from monetary policy and gone wrong, velocity falling, and that's the bad deflation side of it. But then you've got the good deflation side of it, as you said, and I always want to end on a very hopeful note. And the good, the very positive form of deflation we're going to see, if we're right, is going to cause enormous growth in everything blockchain related, in all that innovation. as well as, the other platforms, the multi-omic sequencing, robotics, energy storage, and artificial intelligence. And they're all going to start converging. And, it's messy getting from here to there. But I think, again, just the recognition of what can go wrong with the banking system, I think is going to cause more people to seek more insurance policies. The warning flags we have been observing for more than a year now are signals like credit default swaps on banks and many other companies going up the last year. Now, credit default swaps, for people who don't know, are insurance policies against the bankruptcy of corporations. They're actually bets on the bankruptcies. As they go up, the probability of bankruptcy typically is increasing for some reason or another. And so last spring of 22, I was pointing to credit default swaps going up. What's this about? And then the yield curve inverted in July. The yield curve inversion has always led within 12 to 18 months to a recession. And so I was pointing to that. Commodity prices were falling. The oil price peaked at $130 in March of last year, I believe, and has been nearly cut in half. And I finally wrote a letter to the Fed. I don't know if you saw that, Balaji, but which basically said, wait a minute, you're hiking interest rates 75 basis points at a time and hiking interest rates faster than any other Fed in history, 20-fold within 1 year, it turns out. And here are these conflicting signals, and you're voting unanimously to raise the rates like this. And so I have been much more concerned about deflation. And I think the bank crisis has punctuated that, because the two big mistakes that banks have made was assuming that interest rates would stay very low for a long time, because the Fed told them that during COVID. And so they invested in long-term government-backed securities, figuring out they'd be money good when they matured. So that was the first mistake. And then the second mistake was to assume that deposits would not leave the system. It wasn't just Silicon Valley Bank. Deposits are leaving the banking system because money market rates are so much more competitive than what people are getting in their bank accounts. So for the first time since the 1930s, we have a decline in M2 on a year-over-year basis. Started in December. It's intensifying. It looks like it'll be down 3% in March. And I believe this has all the hallmarks of potentially a deflationary bust. It was a flight to safety, 19,000 to nearly 28,000. That, boy, was that proof of concept right there. Decentralized, transparent, auditable, and so forth. So we are on the same page here. I worry that this economic downturn, this deflation, is a much bigger problem right now. And I do, if you're going to say, well, they're just going to throw money at it. We just saw that the Fed raised interest rates for the first time ever in the middle of a crisis. And they've been talking once again about the need to increase interest rates. So I don't think they respect market signals. And this is a big problem. They are not looking at market signals. They're looking at massively lagging and unreliable indicators that are based in a world, the statistics came from the industrial age. So they're not even looking at the right numbers.